The markets are open and we're starting to see red patches across the board, yet when we take a look at the Fear and Greed Index, market sentiment right now still firmly sitting within greed, and today we want to draw your attention to 5 undervalued stocks that have taken a bit of a hit over the last few days. Now the first one is Lockheed Martin in the defense industry. Now over the last 12 months it is still up around 15%. Over the last 10 years, you would have outperformed the S&P up 173%. And right now, in terms of the 52-week range, we are sitting in the mid, moving towards the lower end. Now, when we look at the rating summary, we have a buy from Seeking Alpha, a buy from Wall Street, yet a hold from Quant. In terms of forward yield, right now, 2.43%, and on a forward P basis, just above 20. Remember, S&P right now sitting around 25. When we look forwards to the expectations of the market over the next 4 quarters, we have 2 of them being positive, 2 negative. Yet when we look at the historical performance from management, it does look very good, some sizable beats, and that is a 100% track record. And if that does give you faith, they will hit their EPS estimate in 2025, their next full annual accounts, then the forward P will come down, although marginally, to 19.47. Now, each one of these 5, we will take a look at the dividend safety and the metrics. For Lockheed Martin, very safe, a score of 84. We'll run through these 2 models. A little bit disappointing to see last month an inflationary increase of around 4.8%. Remember, on this channel, at the bare minimum, we do want 4 just to keep up in line with inflation. And just this month, it was reaffirmed their very safe score, which ultimately means a dividend cut for LMT is highly unlikely. Then we get to some of the key metrics telling us how they performed in the 07-09 recession. While they increased the dividend, they had above average growth, that is negative 1.2, with the S&P negative 12, and we can see they marginally outperformed in terms of return, negative 46, the S&P itself negative 55. Now, one of the reasons we were disappointed this year was due to the fact that over both the last 5 and the last 20 years, we have seen some very nice increases from this company, and we can see 21 years they've been consecutively increasing the dividend. 4 more years, they will enter that dividend aristocrat status. Now, the first valuation model we are taking a look at for LMT, we notice it is in the blue tunnel. Remember, this is the expected fair price over time, which means reasonably valued at the current price. But don't forget, we're not looking at any of these models in isolation. We will conclude towards the end of the analysis. Now, dividend yield theory, this tells us a company is undervalued when the current yield sits above the 5-year average. Right now, as the yield for LMT at 2.56 isn't far off the 5-year rolling, you could argue reasonable valuation, although we do notice on a forward P of 18.9 that is above the 5-year rolling of 16.2, but marginally lower than the overall sector for industrials at 20.8. So you can see here it is trading at a very marginal discount to the overall sector. We then move on to the free cash flow payout. Remember, free cash flow on this channel as opposed to earnings, which is susceptible to manipulation by management through accounting. Below 60%, that is our blanket rule. Reason why we look at that, give us faith, management can offer decent increases to the dividend, and we notice pretty much 9 of the last 10 years been below that, 49% in fact over the last 2 years, 52 marginal increase anticipated over the next 12 months, still well below that maximum 60% threshold. We then move on to the free cash flow per share, where we want consistent increases over the longer term. Not as consistent as we like, but not too bad either, nearly tripling that free cash flow position from 2014 to 2023, with a marginal increase anticipated over the next 12 months. Then we get to sales growth, where at a minimum 3 to 7%. In fact, the lower end, 3 to 4, is just to keep up in line with inflation. Very, very inconsistent. 2% in 2023, 5% on a trailing 12 month, telling us that 2024 looks to be a better year, but no massive double-digit increase that maybe we have only seen twice out of the last 10 for Lockheed Martin. Nonetheless, their top line has been growing from 40 billion in 2014 to 68 in 2023. But what they do very nicely, and you could argue somewhat consistently, is returning excess cash to investor pockets through those share buybacks. They've bought back around 25% of those shares outstanding from 2014 to the latest period at 241 million, which, as we always say, is a nice added bonus on top of a nice increase to the yield, which is something they have done on a historical basis. Then we look at the ROIC, 10% or more. Give us faith, management are able to effectively allocate their capital. Very good numbers, very high on a consistent basis, 34% on a trailing 12 month. That is a very strong number, does make it incredibly attractive for investors to add, or in fact continue adding if they already hold it. Then we move on to the operating margin. Around 12% is what we want to see at the bare minimum, which is what we get for Lockheed Martin. Now, you may consider that good, but on this channel, we also want to see companies that are able to do operating efficiencies, which is where we would see an increase of the margin over time, not something we see with LMT. And then we move on to the free cash flow margin, consistently around the 9 to 10% on a year-on-year, 9% in fact over the last two and on the trailing 12 month. So nothing to mention there, which is good, no red flag indicators. Then we get to the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 3 is what we want. Remember, the numbers below reflect the number of years it would take the company to pay off all of their debt net of cash on hand, and this correlates to balance sheet strength, dividend safety. It's been coming down from the highs of 2015 at 4.08, although over the last few years it has started to increase. Nice to see a marginal decrease on a trailing 12-month basis, and expected to be there or thereabouts over the next 12. Not much to say here, it is below the 3, and as we saw above, the dividend does look to be very safe. Now let's jump into the valuation model. As always, if you do enjoy content on this channel, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now typically on this channel, we get to the intrinsic value as the average of the models that you can see, and we run through each one talking about the inputs and the outputs. Today, let's get straight to it. Intrinsically, $642. And what we'd like to do is an MOS, 10% at the bare minimum. Execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, we'll buy up to 578. Then we keep going till it's near the current trading price. And what we can see, we're a few dollars away from this company being a 20% margin of safety, and we still have time today for it to drop down to that level. Wall Street, bullish on this company, upside of 23%. Their price target, $635, only marginally lower than our intrinsic value. 20% MOS, 23% upside. Give us your thoughts below whether this is a buy, hold, or sell. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we highlight severely undervalued stocks that we believe deserve your attention, and also what's gone in the market over the last few days. So click below, sign up, and you can start reading straight away. You'll also be able to gain access to 40 undervalued dividend stocks for the month of November. Lots of information, the upside that Wall Street themselves see over the next 12 months. And on top of that, this month we've just released a latest edition of 29 dividend stocks that Wall Street themselves believe have the most upside right now in the S&P. So click below, sign up, and you can start reading straight away. We then move on to ConocoPhillips. Now we have a double buy rating from Wall Street and Quant. This time it's Seeking Alpha coming in with the hold. But remember, 3.5 to flip to a buy, so they're not far off. This one is trading right there towards its 52-week low. It has a nice starting yield of 3.15% and a forward PE around 14.4. Now over the last 12 months, it is down around 6%. Over the last 10 years, it is up around 59%, and we can see all-time highs sitting around the $134 mark, and that was in 2024. Now it is down around 4% just today, and when we take a look at the expectations, although bear in mind this is a very cyclical industry, we only get one of the next 4 quarters anticipating an increase to the earnings per share, but at a bare minimum over the last 4 quarters they've been in line with 3 beats, which is always great to see. Nonetheless, they expect growth to continue on the earnings per share to $8.37, in turn lowering the forward PE to 13.35. We then get a dividend safety score of 61, indicating safe, a double undervaluation signal with a mammoth of an increase to the dividend last month at 34%. Now, when we take a look at how they performed in the last recession, we can see that they maintained the dividend, they didn't increase it, they also didn't cut it, they had below average growth, negative 58%, with pretty much a near S&P return at negative 56%. Now, this is some very, very nice growth, 34% last month, 32% on an average year on year over the last 5, and 9% over the last 20, although we do have to note they only have 7 years of paying a dividend with consecutive increases. We then take a look at the valuation model, and in terms of over the last 12 months, this is the first time that this company is trading severely undervalued. In fact, we notice the expected price has gone up, could possibly be due to earnings increase, yet the valuation hasn't gone up to support that. So there is a widening of that undervaluation gap. And when we take a look at that dividend yield, we can see 2.9%, well above the 5-year 2.12. However, the forward P right now of 14 does trade above the 5-year rolling of 11.8, and it is marginally at a discount to the overall energy sector of 15.8. Now, when we take a look at the free cash flow payout, below 40% for oil producers, and that is what we see in the shorter term over the last 3 years, although the more recent year, a little bit higher at 64. Remember our blanket rule of 60%, and we do notice on a trailing 12 month and over the next 12 months, it is anticipated to come down into the low 40s. In terms of free cash flow per share, we do notice some negatives, but again, cyclical industry, this is to be expected, and we do anticipate this coming through the metrics more. But over the longer term, we do see an increase, 725 in 2023, a marginal one expected over the next 12. And then when we get to the sales growth, as we said, no surprises here. In fact, we notice 6 of the last 10 years negative growth, including 2023. So when you do zoom out and look at it from a numerical perspective, we can see a lot of peaks and troughs, 55 billion in 2014, down to 19 in 2020, and up to around 58 in the more recent period. Now, they've done it all. They've issued shares, they've bought back shares, but marginal net share buyback from the 2014 position of 1.25 billion to 1.18 in the latest quarter. ROIC above 8%, so we lowered it a little bit for oil producers, something they have done very well over the last 3 years, and on a trailing 12 month at 20%. But remember, ideally with cyclical companies, you do want to get them when they are out of favor, when investors are selling, and they do look very undervalued, and a great opportunity does arise. Then we get to the operating margin above 12%, something we see straddle on a year-on-year basis. Nice to see some very high numbers over the last 3, including on a trailing 12 month. And the same to be said on the free cash flow margin, 16% on the trailing 12 month. Then we get to the net debt to EBITDA, very important, below 1.5. That is what we see over the last 3 years and expected to marginally decrease over the next 12. So we do believe that dividend does look to be safe, and the balance sheet, based on the data at the moment, does look to be secure. Now, our intrinsic value, $139, not far off Wall Street, 135, where they see upside of 26%. And when we look at it in terms of the MOS, in today's episode for COP, you're not getting 25% just yet, but it's sitting somewhere between 20 to 25. Nice starting yield, nice increase we got last month, and we can see Wall Street also bullish, upside of 26%, and do give us your thoughts below. Maybe in fact you prefer other ones within this industry. We then move on to L3Harris Technologies with a double buy rating, a hold from quant. This one is trading towards the upper end of the 52-week range, a forward yield of 1.87%, a forward PE sitting there at 19, and over the last 12 months up 28%, but we do see it down around 3% on the day. Over the last 10 years, massive outperformance of the S&P, up 236%. Great always to see green right across the board, meaning expecting growth on the earnings per share over the next 4 quarters and outperformed over the previous 4. And we can see here earnings per share expected to increase, and therefore forward P expected to lower to around 17.34. We then get a safe score of 80. We'll cover these two, but very disappointing this February, where we did get a mediocre below inflation 1.8% increase. In terms of dividend safety, well, just reaffirmed a few weeks ago that it is safe. And when we get to the key metrics, they increased the dividend, they had average growth, and they also marginally outperformed the S&P, negative 49%. And again, this is the reason why we are disappointed with companies this year that have offered very low increases, because the majority of them on a historical basis have increased them at a very, very rapid rate. We also notice, very similar to Lockheed Martin, they are only a few years away from gaining that dividend aristocrat status. And when we get to the valuation and we do zoom in over the last 12 months, we can see it's pretty much been floating around the expected fair price, and we see the same at this point in time at reasonable valuation. In terms of dividend yield theory, well, right now you are pretty much around the 5-year rolling, and you could argue the same for the forward P, so double reasonable signal, but we do notice that this is trading at a discount to the industrial sector of 20.8. In terms of looking at the free cash flow payout, below 60% is what we get every single year, expected to lower to 30% over the next 12 months, so we really do hope for an above inflationary increase in 2025. Free cash flow has been increasing but very inconsistent, massive jump, nearly double anticipated over the next 12 months. And when we get to sales growth, unfortunately 5 of the last 10 years have been negative, 2023 and a trailing 12 month looking like some big years, both 2023 and 2024 expected. Then when we zoom out, yes, we do notice massive growth, around 5 times from 2015 to 2023, but we also do see it fairly flat just over the last few years. In terms of shares outstanding, we can see, in fact, from 2019, they have been doing some consistent share buybacks, and hopefully that is something as part of management and their capital allocation, because truly this year was a very, very poor increase to that dividend. ROIC around 10% is what we get, although fairly inconsistent, 7% on a trailing 12 month. Hopefully we do see it back up to the levels of 2016 and 2019. And then in terms of the margins, like we say, we want to see operating efficiency. You could argue here we notice operating deficiency, where in fact it's gone from 20% to 12% in 2023. And in terms of free cash flow, it does look like a decreasing trend, but nonetheless above 5%, maybe something as an investor or potential investor you do want to keep an eye on. Then we get to the net debt to EBITDA. Below 3 is what we want. We don't really get that, and not that often either. It's 3.15 in 2023. Yes, it is expected to come lower over the next 12 months, but definitely something we would say to keep your eye on if you are an investor. In terms of the valuation, and remember you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for LHX or any other companies that you do desire. So intrinsic value of $305, when we run it through the MOS in today's episode, what we actually get is pretty much a 20% margin of safety up to $244, with Wall Street on the other hand giving this upside of 21%, their price target $290. Definitely one to consider, especially if you are lacking this exposure for the industry within your own portfolio. We then move on to one of the Mag 7, Microsoft, with a strong buy from Wall Street, but both seeking alpha and quant, even though they do have holds near around the 3.5 that would flip them. They have come quite some way away from their 52-week high of $468. In terms of yield, we're around 0.8%. In terms of forward P, just below 32. Over the last year, not great at all, up only 10%. Over the last 10 years, though, we do notice massive outperformance of the S&P, up 769%. Green again, right across the board, love to see that. Growth anticipated, 100% historical forecasting accuracy, and no surprises for this company. Growth is anticipated over the next full year, lowering the forward P to just below 28. We then get a dividend safety score of 99, the highest score obtainable, and a very nice and consistent increase with this company at 11% in September. In terms of the last recession, well, surprisingly, they maintained the dividend, they didn't increase it. They had near enough average growth, whilst also marginally outperformed the S&P, negative 48. As we can see, their increases here are fairly consistent around the double-digit rate year on year, and they've been increasing those dividends for the last 14, whilst paying a dividend for the last 18 without a reduction. In terms of the valuation, when we zoom into over the last 12 months, we notice it pretty much around the middle of this blue tunnel, thereby indicating reasonable valuation. And when we get to the yield, you could also argue on the front of the dividend yield as well as the forward P that both are very, very near to their 5-year rolling. That again is another reasonable signal. Although we do notice, unlike the majority of companies we've covered today, Microsoft does trade at a premium against the overall sector, which in this case, information technology, is 25.7. Free cash flow payout, well, below 60 and consistently, which gives us no surprises why we get that consistency in those dividend increases. In terms of free cash flow, maybe one of the most consistent we can see in terms of the growth, more than 3 times, although do be aware over the next 12 months we are anticipating a marginal drop. And then we get to the sales growth, nearly double digit every single year, 2024 looking very good as well as a trailing 12 month, and when we do zoom out we can see more than double across the period. In terms of shares outstanding, not something they particularly prioritize, as we can see, very inconsistent. In fact, just over the last few years, they've bought back no shares. But again, you could argue maybe they believe at this point, or the point they were considering, the company was overvalued. We then get to the ROIC, looking phenomenal, around 30% in 2024. These are some very good numbers, and in fact been increasing from the lows of 2017. And then we get our operating efficiency that we've been discussing throughout the episode. 30% operating margin in 2015, 44 on a trailing 12 month. No complaints whatsoever. Free cash flow margin looking very strong. Definitely a free cash flow machine. And the net debt to EBITDA below 3 every single year. Incredibly low at 0.12 over the next 12 months anticipated. And therefore we can see why they got that very safe dividend score. Now our intrinsic value, 494, not far off Wall Street's 500 where they see upside of 20%. And when we do run it through the MOS in today's episode, not at the 20% level just yet, we see around 15% up to $420, which for a Mag 7 high quality company, you could argue this is one to definitely dollar cost average in at today's entry. As always though, do give us your thoughts below. We then move on to Applied Materials in the semiconductor space with a double buy signal and the hold from Quant. We notice it is trading towards the lower end of the 52-week range, a yield of 0.91%, a forward P of 18.32. Now over the last 12 months, up around 16%. Over the last 10 years, massive outperformance of the S&P, up 630%. And again, a nice full green right across the board. Remember, 100% historical forecasting accuracy, as well as anticipating growth every single quarter. Nonetheless, October 2026 EPS 10.78, thereby lowering the forward P to 16.23. We get another very safe dividend score at 86, a very strong dividend increase at 25% in March this year. And when we take a look at the key metrics, in the last recession they maintained the dividend. They had below average growth at negative 38%, whilst also marginally underperforming the S&P negative 57. Now, nice increases are no surprise to this company. We get double digit every single year over the last 10 on average, with that very nice, in fact, in 2024, 7 years of consecutively increasing the dividend. And when we get to the valuation and do zoom in over the last 12 months, for the first time in quite some time, it's entered into reasonable valuation. Then we take a look at dividend yield theory and forward PE. Similar to a few today, they aren't far off the 5-year average, so you could argue, again, reasonable valuation, although we do notice trading at a massive discount to the information technology at 25.7. In terms of the free cash flow payout, below 50% nearly every single year, so look, no surprises why we get those increases on a consistent basis. 20% over the next 12 months anticipated, and the free cash flow, whilst inconsistent, has increased dramatically from 78 cents in 2015 to $9 in 2024, although we do bear in mind this is a cyclical industry and a drop is anticipated over the next 12 to 788. We then move on to sales growth, where we see a lot of inconsistency right across the board. 2%, so marginally below inflation in 2024, and when we do zoom out in terms of total sales, we can in fact see 2015 to 2024 around 3 times growth, and this is a company that has been aggressively buying back shares from 2015's 1.2 billion to the latest quarter of 834, and when you combine that with the nice increase to the dividends, that is a very strong combo for investors. In terms of ROIC, well, looking very good, 31% in 2024, some very high numbers right across the board. And then we get to operating margin, where we do see some signs of operating efficiency, although it has stayed fairly flat over the last few years. And free cash flow, again, nice free cash flow machine, 29% over the last 2 years, as well as on a trailing 12 month. We then get to the net debt to EBITDA, the cherry on top, below 1.5 indeed. 23, 0 in 24, 0 on the trailing 12 month, and 0 anticipated over the next 12. A very good balance sheet. And in terms of valuation, also looks very good. Our intrinsic value, $237. Wall Street, 223. They see upside of 28% over the next 12 months. And in today's episode, we do see quite a nice margin of safety. At the 25% up to $178 is where this company sits. So AMAT, Applied Materials, 25% MOS, 28% upside. Is this one you are considering in the semiconductor industry? Give us your thoughts below. If you did enjoy today's episode, smash that like button, hit that subscribe and bell button so you are notified of these videos when they drop. Don't forget to sign up to the free weekly newsletter below, and also come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.